This PowerPoint provides an introduction to the use of ratio analysis in the analysis of financial statements for not-for-profit organizations, focusing particularly on hospitals, colleges, and universities. Ratio analysis is the foundation of financial statement analysis. It provides a basis for comparing an organization to itself over time, to other similar organizations, or to averages for organizations in its industry. And industry in this case might mean the hospital industry, the not-for-profit hospital industry, or the private college and university industry. Ratio analysis also identifies an organization's financial strengths and weaknesses. It also can identify areas where an organization's financial position is strengthening or weakening over time. But a few cautions about the use of ratio analysis. First of all, the quantitative analysis must be interpreted in the context of the analyst's qualitative understanding of the organization, its strategies, and its operating environment. Ratio analysis isn't a cookbook. It's just not a matter of calculating a number of ratios, adding up the results, and declaring the organization financially sound or financially weak. It requires a lot of judgment on the part of the analyst. It's always best to look at multiple ratios rather than a single ratio in isolation. Looking at multiple ratios can point to important issues if they are all pointing to similar strengths or weaknesses, while one ratio in isolation may not be meaningful. The value of a particular ratio is meaningless unless there's something to compare it to, which is why we always compare the ratios for a particular organization to itself over time, to similar organizations, or to industry averages. Be careful, a ratio that may make sense for one type of organization may not be meaningful for another type of organization. Ratios that are meaningful for hospitals and colleges and universities may not be meaningful at all for charitable organizations or for governments. Comparisons should always be made only to organizations in the same industry. Comparing the ratio for a charitable organization to a hospital may not be meaningful. The liquidity and leverage needs of a hospital are very, very different from a charitable organization. And comparing a not-for-profit organization to a government would not be meaningful either. Due to accounting differences, sometimes it's necessary to adjust financial statements prior to calculating ratios. The different organizations may actually have made different assumptions within the rules permitted by GAAP for issues like the treatment of depreciation, the useful life of capital assets, whether a lease was capitalized or treated as an operating lease. So in some cases, it may be necessary to adjust financial statements before calculating ratios. And be cautious when comparing your results to the results calculated by another analyst. Formulas are not always consistent, so you may be comparing apples to oranges in this case. Remember, there's no gap for ratios. The formulas are not defined officially anywhere. Every analyst uses his or her own variation on the basic formulas. Finally, be skeptical of rules of thumb. There are a lot of them out there that you will see and hear. For instance, many people say the current ratio should be 2.0 times or greater. That may or may not be appropriate in the case of a particular organization. It's always better, as I said, to compare the results for your organization to its peer group. Types of ratios that are often calculated for not-for-profits include common size ratios, liquidity ratios, leverage or coverage ratios, which are also sometimes known as solvency or debt ratios, profitability ratios, and sometimes some non-financial ratios. Common size ratios facilitate the comparisons over time and across organizations by correcting for differences due to size. For example, Common size ratios facilitate the comparison of organizations over time and to one another by correcting for differences due to size. For example, one organization may have $1 million in cash, another organization may have 500,000 in cash. But we can't really conclude that the organization with $1 million in cash is more liquid because we have to measure its cash relative to the size of its operations or relative to its amount of total assets. In calculating a common size ratio, every item on the financial statement is compared to or divided by one key number from the statements. So for example, items on the balance sheet may be compared to total assets. Items on the income statement may be compared to total revenues. Some common size ratios may be particularly meaningful. For example, they may point to important strengths, financial strengths, or to important financial risks. For instance, in the hospital industry, Medicare and Medicaid revenues as a percent of total patient services revenues can be a weakness if it's high because Medicare and Medicaid pay less than other insurance providers. For a university, investment income as a percent of total revenues can be a strength if it's higher because it indicates that the university has a large endowment and has investment income it can rely upon and it is less dependent upon tuition. Examples of the calculation of common size ratios for the balance sheet for a not-for-profit would look like this. Here you see for both years 2011 and 2012, every item on the balance sheet has been divided by total assets and converted into a percentage. So for instance, cash in 2011 was equal to 7% of total assets. In 2012, it had risen to 8.9% of total assets, and so on. Common size ratios for the income statement or statement of activities for a not-for-profit. In this case, we're just looking at the unrestricted net assets portion of the statement of activities. In this case, all the items on the statement are divided by total revenues. In this case, we've decided to include within revenues net assets released from restrictions because that's another source of resources for the unrestricted net assets. So in this case, grants represented 45.8% of total revenues and other support in 2011, and in 2012 it was similar, 45.9%. Liquidity ratios. Liquidity ratios measure whether an organization has enough cash and other liquid resources to meet its near-term obligations. So can it pay its bills in the near term? Very common liquidity ratios include the current ratio, the quick ratio, and days cash on hand. This slide shows the common formulas used for these three ratios. Current ratio is usually calculated as current assets over current liabilities. Quick ratio is a more conservative ratio, and it's equal to cash plus marketable securities plus accounts receivable over current liabilities. Days cash on hand is equal to cash and marketable securities divided by operating expenses minus bad debts minus depreciation, in turn divided by 365. In the case of all three of these ratios, higher is better in that a higher ratio indicates, a higher value for the ratio indicates greater liquidity. So if these ratios are higher than the average for the industry or higher than for comparable organizations and they are increasing, that's an indication of strong and improving liquidity for an organization. Although current ratio and quick ratio are very commonly used and are easily calculated, days cash on hand is actually a better measure of short-term liquidity because it compares cash and marketable securities to operating expenses as shown on the income statement rather than just being a snapshot from the balance sheet. Leverage or coverage ratios, which I said before, are also known as debt or solvency ratios. These measure the extent to which an organization has used debt to fund its assets and support its operations. And in doing so, they measure the ability of an organization to meet its long-term obligations, meaning to pay its bills in the long term, particularly to repay debt. Common leverage and coverage ratios are debt to assets, debt to equity, and times interest earned. The formulas for these ratios are shown here. Debt to assets is total debt over total assets. Debt to equity, total debt over total equity, or in this case, instead of equity, it would be total debt over total net assets, in the case of a not-for-profit, times interest earned is the increase in net assets before interest expense divided by interest expense. In the case of debt to assets and debt to equity, a lower number is better. So if these values for your organization are below industry averages and going down, that would be a sign of strength. In the case of times interest earned, a higher number is better. So if for your organization, an organization, times interest earned is above the industry average and increasing, that would be a sign of strength. A caution here, while debt to assets and debt to equity may be appropriate for an organization like a hospital or college or university that uses its assets to generate income and therefore potentially to pay off its debt, these ratios may not be meaningful for a charitable institution which doesn't use its assets to raise income, or a government. Profitability ratios. These measure the extent to which an organization generates positive income from its revenues and its assets. While not-for-profit organizations certainly don't seek to make a profit, revenues and expenses must at least equal over time, over the long term, for the organization to remain solvent. And it's generally desirable to generate positive income to create a financial cushion or to help fund capital acquisitions. Again, be careful. While profitability ratios may be meaningful for organizations like hospitals and colleges that generate revenues from operations and from the use of their assets, they are not particularly meaningful for charitable organizations that rely primarily on grants and gifts. And as we'll see in our next class, they're not particularly meaningful for governments either, which rely on taxes. Common profitability ratios are the operating margin, return on net assets, and return on assets. The ratios are shown here. Operating margins is increase in unrestricted net assets divided by total unrestricted revenues and support. Return on net assets would be increase in net assets divided by net assets. Return on total assets would be increase in net assets divided by total assets. In all three cases, a higher value for these ratios would be a sign of strength for an organization. Finally, in some cases, it's appropriate to calculate some non-financial ratios, which can point to areas of current or future financial strength or weaknesses. Appropriate ratios would be very industry specific. One example is for the colleges and universities, selectivity and matriculation, which measure the percentage of applicants accepted and the percentage of admitted applicants who actually enroll, can measure the college or university's market position. And a stronger market position measured by higher numbers for these two ratios indicate that its ability to raise revenues in the future is stronger. Now I encourage you to go back and look at the examples in the lesson of applying these ratios to the analysis of 3 different private not-for-profit colleges and how we reach conclusions about their relative financial strength. And then I also encourage you to go back and read the Moody's median publications that are posted under this class on the website. And those will show you a wide variety of the ratios that are used by analysts to evaluate the financial condition of hospitals, colleges, and universities.